Hey everyone, welcome back to Corporate Decoder, the place where we dive deep into the financial secrets of big companies. And today we're looking at the Federal Home Loan Bank of Chicago's latest report. And let me tell you, this one's got some interesting numbers tied to how they fund their operations. Before we jump in, if you're enjoying these deep dives into corporate filings, hit subscribe so you don't miss out. Also, we have a fantastic community over on Discord where we break down these reports even further. The link is in the description below, so come join us. So what we have here is a current report, specifically an 8K filing. Think of this as a way for companies to announce major events that shareholders really need to know about right away. In this case, for the Federal Home Loan Bank of Chicago, it's all about how they raise money. The Federal Home Loan Bank of Chicago, or FHLBC for short, is a bit different from your typical publicly traded company. It is a federally chartered corporation, meaning it is set up by the government, and its main job is to provide funding for housing finance. They get most of their cash by selling what they call consolidated obligations. Now, these consolidated obligations are essentially loans that the federal home loan banks take out from the public. The key thing here is that by law, all 11 federal home loan banks are on the hook for these debts together. This means if one bank can't pay, the others have to step in. It's like a big cooperative debt agreement. These aren't guaranteed by the US government though, so it's important to remember that. This filing focuses on specific debt issuances. The report provides a schedule called Schedule A, detailing bonds and discount notes that FHLBC plans to issue. They've excluded short-term discount notes because those are pretty standard and happen all the time. What they are highlighting are longer-term debts or debts where they're taking over the primary responsibility from another federal home loan bank. Let us dive into Schedule A. We see several debt issuances planned with a trade date of the 17th of September 2025. For instance, there is a bond with a CUSIP number 3130 B724. This particular bond is set to settle on the 24th of September 2025 and matures on the 24th of September 2029. It is a fixed rate bond, meaning the interest rate stays the same throughout its life. At a coupon rate of 4.050%, the bank is issuing a principal amount of $25 million for this one. Then we have another CUSIP, 3130 B7TX2, also traded on the 17th of September 2025. This one settles a bit sooner on the 22nd of September 2025 and matures on the 10th of September 2027. It has a slightly higher coupon rate of 4.125%. Interestingly, there are two entries for this same CUSIP. One is for $10 million and the other is for a much larger $50 million. So, in total for this specific maturity and rate, FHLBC is looking to raise $60 million. This could be for various funding needs like providing loans to member institutions or refinancing existing debt. Moving on to the 18th of September 2025 trades, we see CUSIP 3130 B7 SK1. This is a longer term bond, maturing on the 26th of September 2040, so it is a 15-year loan. It's a fixed rate instrument with a coupon of 5.450%, and the bank plans to issue $15 million worth of it. This is a higher interest rate, which often correlates with longer maturity periods as investors demand more compensation for tying up their money for longer. Another long-term debt is identified by CUSIP 3130 B7UG7. This one matures on the 26th of September 2045, so it is a 20-year bond. It carries a coupon rate of 5.600%, the highest we're seeing on this schedule, and FHLBC is issuing a substantial $40 million of this debt. Again, a higher rate for a longer commitment. Finally, for this quick look, we have CUSIP 3130 B7. 5 also traded on the 18th of September 2025. This bond matures on the 9th of October 2030, making it a 5-year debt. It has a coupon rate of 4.175% and the bank is issuing $50 million. A common feature across these issuances is the optional principal redemption call type. This means FHLBC has the option to pay back the principal of these bonds early on certain dates. The call style for many of these is Bermudan. This means the bank can choose to buy back the bonds on specific scheduled dates, but not just any day. It is a bit more flexible than a European call, which is only on one specific date, but less flexible than an American call, which can be any time after the first redemption date. And as we mentioned, the rate type and subtype for most of these are fixed constant. This simply means the interest rate is set and does T-change over the life of the bond, which provides predictability for both the borrower and the lender. So, putting it all together, FHLBC is actively managing its funding by issuing a variety of bonds with different maturities and interest rates on the 17th of September and 18th, 2025. They are raising a significant amount of capital, totaling well over $100 million just from these highlighted issuances. This strategy of issuing debt directly from the capital markets is crucial for a federal home loan bank because it is how they acquire the funds to lend to their member institutions, primarily for mortgages and other housing-related activities. Now, looking at these numbers, FHLBC is clearly in a phase of active fundraising. The mix of short and longer. Term debt suggests they rebalancing immediate funding needs with longer. Term capital structure planning. The fact that many of these are callable bonds, particularly with a Bermudan style, gives them flexibility. If interest rates fall significantly after these bonds are issued, they can potentially refinance at a lower cost by calling back these expensive bonds and issuing new ones at a lower rate. This is a smart move for managing their interest expenses and ultimately their profitability. A notable risk here, though, is interest rate fluctuation. While they are issuing fixed rate debt, which protects them from rising rates on these specific issuances, unexpected economic shifts could impact their overall cost of funding or their ability to lend profitably. The joint and several obligation aspect also means they are indirectly exposed to the financial health of the other 10 federal home loan banks. In conclusion, this report simply shows FHLBC is doing what it is designed to do, raise capital through debt markets to support housing finance. The specific issuances detailed here are standard practice for them, but the amounts and terms provide a snapshot of their current funding strategy. They appear to be prudently managing their debt with elements of flexibility built into their bond structures. Alright, that is our breakdown of the Federal Home Loan Bank of Chicago's latest filing. What is your take on these debt issuances and what they signal for the housing finance market? Drop your thoughts in the comments. If this analysis was valuable, hitting that like button really helps. And subscribe for more deep dives. Don't forget to check out the Discord in the description. Thanks for watching. See you next time.